So welcome all to this session of the ABM4Policy seminar series. So my name is Martin de Schweiger, and I'm one of the organizers of the series. So I'm very delighted that we have Graeme Cokayne from the Central Bank of Denmark present today, where he works in the Financial Stability Department. So just a little bit of background for the benefit of those joining us today for the first time. So the series is all about agent-based modeling and its policy applications. So we are kind of aiming for a diverse mix of presentations from academics and policymakers, for example, from central banks or international organizations. So if you've listened into kind of the last couple of presentations, I think we had like quite a few people from academia. So I'm very happy that we have a kind of practitioner from a central bank present at this session today. So we'll have 1 hour for the seminar. So if you're not speaking, then please be sure that your microphone is muted to limit background noise. I think, Graeme, you will pause at some point during the presentation for some kind of questions, I guess mainly understanding, but let's kind of have the most questions on substance at the end of the presentations, like the last 10 minutes or so, just to collect them at the end. Unless you kind of have a fundamental point that kind of prevents you from understanding, then feel free to raise that point. So in order to do that, you can either kind of put an asterisk in the chat function, or you can raise your hand in Zoom. And when you do that, then I'll be able to kind of moderate and let Graeme know that there are some questions coming. But as I said, like if you can have most of the questions at the end of the presentation. So you'll see I'm kind of recording the seminar. So the plan is to put it online. So we've had like some technical issues in the past, but hopefully it will work at this time. So just for you to be aware of that. Yeah, so that's all for me. So without further ado, Graeme, over to you.
Thank you, Mark. Yeah, so this is work that I've done jointly with Christian Bentzen, Eddie Gerba, and Rasmus Pank. When we did it, we were all at the Danmarks Nationalbank. Now Eddie's moved to the Bank of England and Rasmus is on secondment to the ECB, but nonetheless, we did it under the auspices of Danmarks Nationalbank. The paper is called Thank Me Later, Why is Macroprudence Desirable? So we are looking at macroprudential policies and why authorities might want to introduce them. So just to give you an overview of the presentation, since the financial crisis, many macroprudential measures have been introduced across Europe, particularly across Europe, but also other places as well. This is especially true for the housing market, which obviously raises certain questions. For example, have these macroprudential measures achieved what they're meant to achieve? Now, there's some literature on this coming through. However, another question is, of course, have there been side effects? Have there been unwanted effects from these macroprudential policies that weren't intended but are coming through as well? There's very little literature on this. So in this paper, we are attempting to answer these questions and potentially provide a little more literature to answering these questions. So I'll start off going through a brief introduction to it all. So what we're mainly looking at are borrower-based measures. So since 2008, many authorities in Europe have engaged in macroprudential policy. And borrower-based measures are one set of macroprudential policies that are specifically aimed at the over-indebtedness of households and the financial vulnerabilities of borrowers. So here by borrower-based measures, we're talking about measures such as the imposition of loan-to-value ratios, loan-to-income ratios, debt-to-income ratios, debt servicing to income ratios, and so on and so forth. Borrower-based measures generally work by limiting the borrowing capacity of households when they try to purchase, particularly a home, by saying, they're only allowed to borrow so much compared with either the value of the house or their income. So the question sort of comes up, well, do borrower-based measures actually harm the households they're designed to protect? This is sort of a large motivation of this paper. So, for example, poorer households might be shut out of the credit market and hence the housing market and this ends up entrenching their lack of wealth. So for most households, their major investment is in their house, in the housing market, and so if they are locked out of the housing market because they can't borrow enough money to get into it, this will entrench their lack of wealth if they are poor. This is also potentially a large problem for particularly young first-time buyers, for young households trying to get onto the property ladder. They might be then kept out of the market by the introduction of these borrower-based measures, and hence they, as I say, remain outside the market. And this could well become an intergenerational problem if it's only older households that can actually enter the market. So it could well be that you need to have a parent who's already on the housing market, who then helps you enter the housing market. If you don't have an older parent who's in the housing market, then if these borrower-based measures keep you out of the housing market, this can become an intergenerational problem. So essentially the purpose of the paper is to evaluate the effectiveness of borrower-based measures as well as any unintended consequences. Now, there are various issues with evaluating borrower-based measures. First of all, these measures are fairly new, so there's not a lot of history to them. Generally, when investigating policy measures, you'd probably want to have 1 or 2 cycles. If they're, in this case, housing policies, you want 1 or 2 housing cycles to be able to evaluate what effect those measures have had. We don't have that, so there's limited econometric insight that we can get. Also, several policies are often implemented simultaneously or sequentially in most countries. So therefore, it's very hard to isolate certain policies from others. How do you isolate a loan-to-value ratio from a loan-to-income ratio if they were implemented at the same time or fairly closely following one another? Alternatively, often these measures are often implemented after or in conjunction with shocks. So then you have to try and separate the effect of the measure from the shock that it was implemented in relation to. You potentially have endogeneity problems here, and certainly it makes it a lot more complicated to extract information from this. So we see that there needs to be a multifaceted approach in order to fully evaluate the effectiveness of borrower-based measures and any unintended consequences of them. So our approach, what we've done here is to first do an empirical microanalysis using household level data to try to get some background stylized facts about the housing market in the face of borrower-based measures that have been implemented. We conduct an agent-based model in order to isolate the effects of the borrower-based measures and to examine any distributional effects that they might have on households. And finally, we use a DSG model to assess the overall effectiveness and general equilibrium effects of the borrower-based measures. So we try, as I say, this multifaceted approach to hopefully extract some information from the data. So in this presentation, I'll start off with giving you some Danish context. So the implementation of borrower-based measures in Denmark and a brief description of the Danish housing market over the past few years. I'll then introduce some first order effects using these micro data analysis using household level data. I'll then go on to the agent-based model to give you some of the distributional effects of loan-to-value ratios. And finally, I'll finish off with the DSG model to examine the general equilibrium effects of these policies. So to start off with, just to give you a background on the Danish housing market, we see here the price of houses and flats in Denmark. The solid line is the nominal price. The dotted lines are the prices deflated by inflation, essentially. So what we see is there was a large run-up in the price of houses and flats coming into the financial crisis. Very strong growth there. Then following the peaks, there was a large falls in the price of houses, and there was also a fall in credit at this time. In Denmark, we didn't see the strong negative consequences for households that we saw after the early 90s crisis in Denmark, so there weren't so many forced sales of houses at this time compared with the early 90s. However, there were macroeconomic consequences. Basically, had highly indebted houses who, or highly indebted households rather, who retrenched their consumption somewhat, which then had effects on the macroeconomy. Since the trough, however, we've seen quite a divergence in the country, both between, or mainly between the urban centres and the other areas of the country. So you can see very strong growth there in the flats, particularly in Copenhagen. The price of flats in Copenhagen have recovered very strongly, gone past their previous peak. However, family houses outside of Copenhagen or across all of Denmark have only recovered very slowly. So you get this, these differences between some of the major urban centres, especially Copenhagen, and the rest of Denmark. So more generally, we've seen macroprudential policies being introduced in response to household vulnerabilities. So low interest rates and deferred amortization have meant that Danish households can now borrow far more than they previously could. So the current low interest rates, and banks have introduced deferred amortization. So Danish households can borrow more than they previously could compared with their income. So this means that Danish households are highly indebted. However, they do also have a large value of assets. So it's not like they are underwater at the moment, but they are highly indebted, which means they are vulnerable to shocks, particularly shocks in the housing market. And in response to this vulnerability, Danish authorities have introduced a number of macroprudential measures over recent years in order to try to shore up households against any shocks that might occur. So on this diagram, we have various of the policies that have been introduced. So in 2013, there was a debt service criterion introduced at origination. So the borrowers have to be able to service a 30-year fixed rate annuity at the origination of the loan. In 2014, Danish authorities introduced what's called a supervisory diamond for the mortgage credit institutions. So there are limits on their lending growth, limits on their large exposures, their funding sources, and the types of lending that they could do. In 2015, there was a 5% minimum down payment requirement. So this is essentially a loan to value ratio introduced. In 2016, there were guidelines for banks and mortgage banks, particularly in the Copenhagen and Aarhus area. So these are what we might consider fairly hot areas of the Danish housing market. So there were restrictions on debt to income ratios for non-wealthy borrowers, particularly if they don't choose 30-year fixed rate annuities. And then finally, in 2018, there were restrictions on the mortgage supply for borrowers with a loan-to-value ratio greater than 60% and debt-to-income ratio greater than 400%. So over time, there have been various macroprudential measures that have been introduced by the Danish authorities in order to try to shore up the vulnerabilities of the Danish households that are quite heavily indebted. So if we now look at how these measures have been binding on borrowers, we find they're most binding, as you would imagine, on the riskiest borrowers and mortgages. So in this diagram, the horizontal axis has the loan to value ratio in percentage, that's loan to value at origination. And on the vertical axis, this is the debt to income ratio in percentage terms. So basically, banks and mortgage credit institutions can issue any type of mortgage to clients with a debt to income ratio below 400% and a loan to value ratio, below 60%. As you can see there, those are the green circles there with no restrictions there. This is provided the clients can service a 30-year fixed rate mortgage with principal repayments. On the other hand, the most highly indebted borrowers in Copenhagen and Aarhus must in general amortize. So these are the orange circles there. These are specifically guidelines specifically binding for these, what we say, growth areas, so this is particularly Copenhagen and Aarhus. The red circles show that an LTV above 95% isn't allowed. You need to have a minimum down payment regardless of your debt to income ratios. So as we say, it's most binding on riskiest borrowers and mortgages, so those with the highest loan-to-value ratios, the highest debt-to-income ratios, and those that are in particular growth areas. So over time, what has the effect been? Well, what we've seen in the mortgages over time, there hasn't actually, or at least flows from mortgage credit institutions have increased the flow of new lending to all groups of borrowers during the period in which the rules have been implemented. So this hasn't actually stopped mortgage flows. The mortgage flows are increasing. We might say that maybe they would have increased more strongly than what they did, but nonetheless, they haven't actually slowed over time, or at least haven't decreased. And new lending, particularly for house purchases, have been increasing continuously since 2010, totaling 73 billion for Denmark as a whole. And this increase in new lending applies to both first-time and subsequent home buyers. So it's not like first-time buyers are stopping their borrowing, they continue to borrow as well. The flow of home equity withdrawals, which we can see here in the red and orange lines there, have also increased and was quite high in 2018, with significant withdrawals even for people over the age of 60 years. So we are seeing, even with the introduction of these measures, flows for mortgage lending are continuing to increase all across Denmark. So that's sort of the background for the Danish housing market at the moment. We can say Danish households are highly indebted. They continue to borrow at a reasonably high rate, and particularly in certain areas, the house prices are increasing quite sharply. So we now want to turn to just have a first run at the actual data. So we look at its empirical micro-analysis that we're conducting here. So what we want to answer here is that, has the introduction of borrower-based measures actually changed the characteristics of first-time buyers? So here we want to say that this isn't meant to offer a causal explanation, but rather offer stylized facts. As I said before, there's a lot of stuff going on here, lots of different measures introduced, lots of other factors going on. So we're not looking at saying these are causal explanations, but rather saying these are stylized facts associated with borrower-based measures and first-time buyers. Now, there's sort of two effects, generally speaking, we can say that they might have on first-time buyers, that borrower-based measures might have on first-time buyers. So if the borrower-based measure changes the type of mortgage that the first-time buyer chooses, this would, as we might say, affect the intensive margin. Whereas if the borrower-based measures actually lock first-time buyers out of the mortgage market, this would be looking at the extensive margin. And so in this paper, we're probably more looking at the extensive margin than the intensive margin here. So do borrower-based measures actually lock first-time buyers out of the mortgage market? Now, we also should stress that if the first-time buyers are locked out of the mortgage market, this might not reduce overall welfare if these households are nonetheless most vulnerable to shocks. So you might say, you know, if borrower-based measures lock first-time buyers out of the market, you know, is that okay? In a sense, should they be locked out of the market, that they shouldn't be borrowing anyway? I use inverted commas there for should. Or looking at another way, should they be able to borrow, and these borrower-based measures are locking them out nonetheless? So doing this empirical micro-analysis, the data we use is household data from Statistics Denmark. In this data, we observe a number of variables for each household, so their income, their net wealth, the age of the reference person, and various other household characteristics, like where they live and so on and so forth. These are yearly observations from 2010 to 2018. And in this analysis, we broadly break up the borrower-based measures into three sort of phases. So we're not looking at individual borrower-based measures, we're sort of looking at what happened during certain phases. So before 2013, we'd say there are no borrower-based measures, at least not from the authorities. Individual banks might have imposed borrower-based measures on their clients, but these weren't imposed by the authorities. From 2013 to 2017, we call this sort of non-binding borrower-based measures. So this is more guidance from the authorities to banks about what sort of borrower-based measures they should put in place. And then from 2018, or in 2018, we consider there to be binding borrower-based measures on banks. So if we just take a first pass look at the data, we can say there are no obvious changes in household wealth or income from first-time buyers. So what we're looking at here is, if we start on the left-hand side there, this is the household income at T-1, that is the year before they bought a house. So here we're restricting our analysis to the pool of households that hadn't bought a house prior to 2010. And so this is looking at the household income of these households in the year prior to them buying a house. And now this is looking at them compared with other households. So the blue line in the middle there is the median. So we say the median household income of first-time buyers in the year before they bought their first house was around the 75th percentile. Then the dark grey area there is between the 10th percentile and the 90th percentile. And then the light grey is the percentiles outside of that. So just looking at this data, we'd say sort of over the period, with remembering the borrower-based measures were introduced from 2013 to the end, there was no obvious change in the income required of first-time buyers prior to buying their first house. And similarly with the net wealth, if we move to the right-hand side there, that's the net wealth again in the year prior to them buying their first house. There's no obvious change there either. So at a first pass of the data, we'd say the introduction of these borrower-based measures haven't really affected the income required to enter into the market. But to make this analysis a bit more formal, we conduct a simple linear probability model. So the model equation is there. So here Y denotes the probability of buying the first home. I is the index for the households. C denotes the geographical areas around Denmark. T denotes the time measured in years. As we said, this is annual data. And then Z there is the household characteristics, and kappa C denotes municipality fixed effects. And X here, sorry, I should say, is the borrower-based measures. So the introduction of borrower-based measures. So this is the linear probability model we use to try to evaluate this household data. So what do we see from this data? Well, it might be a little hard to see the numbers in this graph, but if we start off here in the first column here, if the only household characteristics here are income and wealth and net wealth, we see that these both are positive, which is gratifying. It's what we want to see. Basically, it says that you're more likely to buy a house if you have higher income or higher net wealth, which is exactly what we'd expect. If we then move to the second column here, we now include variables to say, is the household in the bottom half of the income or wealth distribution, and we interact the income being above or below the median with these borrower-based measures. Now, what we generally see here is that the introduction of the borrower-based measures don't seem to change the probability of buying a house that much over and above the probability, above the probabilities of your income that are given by your income and wealth. So they change it a bit, but not a huge amount. The numbers are fairly small there, and it doesn't seem to be too much greater whether you're above or below the median. So generally what we'd say here, based on this empirical micro-analysis, is that richer households are more likely to purchase a home, which seems reasonable. Borrower-based measures do not seem to affect households in the lower half of the income distribution much more than those in the upper half. So it seems to affect both the upper half and the lower half of the distribution about the same amount. And poorer households don't appear to be overly constrained from the borrower-based measures over and above the effects of their income and wealth. So it doesn't seem that these borrower-based measures are keeping people out of the housing market, and it doesn't seem to be affecting poorer households more than richer households. So that was the empirical micro-analysis. We now want to get more detailed in our analysis, so where we can actually change some of these variables and see what happens. So we move now to an agent-based model. So with the agent-based model, the heterogeneity of the agents means that we can extract distributional data much more easily than with other models. So with models such as the empirical model or the DSG model, which we'll get onto later. In this model, what we do is we essentially manipulate the loan-to-value ratio that's imposed by the central bank, and then they observe the effects of this on the age, income, and wealth characteristics of the home buyers. And we also look at the incidence of negative home equity as a result of the changes in the LTV ratio. So this agent-based model is based on a model by the Bank of England, which Mark and some of his colleagues put together a few years back. However, we have modified it for the idiosyncrasies of the Danish housing market. The main modifications here are that there are no investor or landlord households. Instead, they're rental property owners. So this is one of the features of the Danish housing market. In general, you don't see that individual households will buy, for example, a flat and then rent it out to another household. Rather, you tend to get flats owned by rental property investment companies, and if households want exposure to the rental market, they then invest in these companies instead. We've also included a controlled rental accommodation section in our model. This is a fairly significant part of the Danish housing market, but it's not so relevant to this particular analysis. So we won't be mentioning it much from here on. So in this model, for those who aren't familiar with it, there are 4 types of agents. There are households, there are rental property owners, there's a bank, which is essentially just a mortgage lender, and there's a central bank which imposes macroprudential policies on the bank. And there are 3 types of households. So they're renters, they're first-time buyers, they're owner-occupiers. These households differ in the types of decisions that they make and the conditions that are imposed on those decisions. I should also stress that households do move between these categories. It's not like they're stuck in one of those categories the entire time. They might rent for a while, then buy their first house, be an owner-occupier, and then go back to renting if they choose. They can move between categories. So within the households, they differ on characteristics such as their age, their income, their bank balances. They buy and sell and rent houses. And when buying, they take out a mortgage from the bank. And the bank is subject to macroprudential policies set by the central bank, as I said. So I've got here sort of a schematic of the agent-based model. So if we start up in the top left corner in the sort of pink boxes there, this is the rental accommodation. So the households that are living in rental accommodation, each period they decide whether they want to leave. If they don't want to leave, they stay in their rental accommodation. If they do want to leave, they vacate their house and go to social housing. Social housing is sort of a category where households that are between houses are put in that category. And then all vacant rental properties are then put on the rental market by the rental property owner. And that's essentially the only job of the rental property owner, is to put vacant rental properties on the rental market with some sort of offer for those properties. If we then move to the blue boxes, which is the social housing. So as I say, this is for households that are between houses. So they always want to move out of social housing into a house. So they first decide what their housing expenses are, and then they decide whether they want to buy or rent a house. If they decide to rent, they'll put a bid on the rental market. If they decide to buy, they'll put a bid on the ownership market. And if they need to borrow money, they'll borrow money from the bank, subject to the macroprudential conditions set by the central bank. Then if we move down to the green boxes, that's for owner-occupiers, so households living in a house that they own themselves. They decide whether they want to sell each period. If they don't, then they'll stay. If they do want to sell, they'll give an offer on the ownership market. So then the bids and offers on the rental market and the ownership market are matched, and the winning bidders move into the new house, whether they're renters or buyers. And if the sellers are matched to a buyer, then they vacate the house and enter social housing for the next period. So what do we see when we manipulate the LTV ratio? So in this, the main policy difference is that we get the central bank to change the LTV ratio. So we run a simulation with the LTV at 98, and then we change it for the next simulation to the LTV of 95. We run a number of simulations and then compare the results from this. What we see is that a tighter LTV reduces house price cycles. So here we're measuring house price cycles as the standard deviation in the house price index. So basically, so this is a stationary model. So the house price varies around a stable mean. So the smaller is the standard deviation, the smaller are the house price cycles. and tightening from an LTV of 98 to 95 reduces the house price cycles. What we also see, if we then look at the distribution of the age of households when they first buy a house, a tighter LTV tends to narrow the distribution of the first-time buyer ages. So the median age of first-time buyers doesn't seem to change much under this model. However, we do see that the distribution narrows. So here the red bars are the LTV at 95, the purple bars are an LTV at 98. If you look at the bars below 30 and above 50, you'll see that under the LTV of 95, households are much less likely to buy houses for the first time at those ages. So generally people will buy later, or if they haven't bought by 50, they're less likely to buy in the future with the tighter LTV. When we then look at first-time buyer income percentiles by age, so in this model, the household's income percentile is defined within their age group. What we see is when you introduce any sort of LTV, be it 98 or 95, you're more or less excluding the bottom third of the income distribution. Presumably, this just means that these households find it too hard to actually save enough money to get a deposit, no matter how small that deposit must be. But for households above this income percentile, with an LTV of 98, you see a far flatter distribution here than you do for a 95. So it seems that the tightening the LTV does skew the income percentile of first-time buyer households towards richer households, you can say. Nonetheless, these effects on first-time buyers and the younger households having to wait a bit longer and the skew towards the higher income percentile doesn't seem to keep people out of the housing market permanently. So if we now look at the share of households that never bought a house during their lifetime, we see that remains around 65% of households never buy a house, whether the LTV is 98 or 95. That doesn't seem to have a huge effect on the distribution. So we see that essentially it doesn't seem to be locking households out permanently. However, when we now look at loan-to-value ratios, so we want to look at negative home equity. So the loan-to-value ratio is being 95 or 98, that's at origination of the mortgage. However, after that, the house price might change its value, and so the house price might fall. If the value of the house falls below the value of the mortgage, you can get a loan-to-value ratio above 100%. And as we see here, if you look to the right of the line there, this is the distribution of all households with mortgages, their loan-to-value ratios in any period. You see that the loan-to-value of 98 dominates the distribution of loan-to-values of 95, at least the macroprudential policy of an LTV of 95 or 98. So you're more likely to get negative home equity, that is a loan-to-value ratio above 100, under the LTV 98 policy rather than the LTV 95. Now we see this isn't only the incidence of negative home equity, it's also the severity. So if we think about what's the probability of any household with a mortgage having negative home equity in a period, that's higher under the LTV of 98 compared with 95. And also the severity. So how big is that negative home equity if they have it is larger under the 95 rather than 98 policy. Yeah, larger when it's the 98, the looser policy essentially. So what essentially is happening here is because the tighter LTV policy reduces the peaks in the house price cycle, households borrow less money or at the peak of the cycle, the price has less further to fall, a shorter place to fall if you have a tighter policy. So hence you're less likely to get negative home equity when you have a tighter policy. So to summarize the findings of the agent-based model, we find that tightening the LTV seems to reduce house price cycles. It doesn't seem to change the average age of first-time buyers, but maybe they are a bit later buying, but then also they don't tend to buy if they're in a higher age category. It doesn't seem to affect the share of households that never buy a house, so it seems households aren't locked out of the housing market permanently. but it does seem to reduce the incidence and the severity of negative home equity. So we seem to find that it does what it's supposed to do, reducing the incidence and severity of negative home equity, but it doesn't seem to have these negative consequences of locking households out of the housing market. So now we want to move on to the DSG model. So this is to look at more general equilibrium effects. So we use the DSG model, as I say, to examine the effectiveness of the borrower-based measures. So there's sort of two parts to this, asking, do borrower-based measures reduce the negative effect on households particularly, or alternatively, do borrower-based measures reduce the probability of a financial meltdown? So this is more the general equilibrium effect here. So the model we're using is based on the model of Gerba and Cokayne in 2017. It's a new Keynesian setup, extended to include credit frictions, informational frictions, and heterogeneous expectations. So the credit frictions in the model are caused by the limited borrowing capacity of impatient households. So households aren't free to borrow as much as they like in order to smooth their consumption. So there are credit frictions introduced there. The informational frictions introduced are that agents have only limited capacity to estimate the expected price of collateral and the value at risk of their balance sheet. So they must infer the loan-to-value ratios using some forecast rules. So this is when they're deciding their best borrowing policies. They want to look into the future and see what are their expected prices of collateral and value at risk in the future. So they have to use forecasting rules. And over time, they learn which rule is better. Now, this learning process leads to heterogeneous expectations from these different learning experiences that different households have. So the model itself is calibrated to the Danish economy. In the model, we use three different LTV ratios, one at 98%, one at 95%, and then a very conservative one at 24.8%. This 24.8% is based on historical de facto LTVs for the riskiest loans. So this is sort of as low as an LTV ratio gets reduced to in the Danish economy. Essentially, we estimate that so we get a full range of potential values for the LTV ratio that gets imposed on borrowers. And for each of these, we also include a variant with amortization rules to see whether that affects the model at all or not. So I have here the schematic diagram of the model. So if we start on the left side there, we have the households. So there are two types of households. They're patient households and impatient households. The patient households can save money, which they can deposit with the financial intermediary, which is over on the right-hand side there. The patient households then produce and consume land, while the impatient households only consume land. The deposits with the financial intermediary mean that the financial intermediary supplies loans to the credit market, while the impatient households demand loans from the credit market in order to consume the land. And then the financial intermediary also holds the collateral of the impatient households. The central bank is there essentially to impose macroprudential policies on the credit market. So here's where we can manipulate the loan-to-value ratios in particular. There's also some financial engineering going on here. We'll probably skip over that in this presentation. So what do we find the results from this DSG model? We find that the 95% rule, that is moving from the 98% rule to the 95% rule, reduces systemic risk and improves the welfare of the average household. So what does this mean in practice? It means that it reduces the probability of large price falls in the land market, which we can think of as the housing market, by restricting credit to the riskiest borrowers. It then smooths the credit cycle, which helps households with their intertemporal planning, and both of these effects improve overall welfare. So if we want to put some numbers on all of this, the 95% rule reduces the probability of household default by 50%. The land price falls are reduced by 20%, and the variation in leverage is reduced by a factor of 3. Banks become safer essentially because they have less credit risk, there's lower household default probability, and less frequent reversals in the price of collateral. So the banks overall are safer. and consumption in the long run is higher and its variation is reduced by half. So we get, and in this model, we essentially proxy welfare by consumption, so welfare is higher and has lower variation. So to see this visually, here we have a histogram of consumption growth. So the blue histogram there is the LTV at 98%. The red histogram is the LTV at 95%, and then the green histogram is the LTV at the very conservative 24.8%. So what you can see is when you move from the 98% to the 95%, the distribution becomes narrower. You lose the large growth in consumption, but you also lose the large dips in consumption. So the cycles in consumption get reduced. It's hard to see here, but the median also actually increases somewhat with the move to the 95%. But then when you move to the more conservative 24%, the entire distribution shifts down to the left, so you get a reduction in consumption and hence welfare. So what we'd say is tightening the LTV ratio improves welfare, but you can very much reduce the LTV far too much. And so you're essentially excluding households that you shouldn't be excluding, and this actually reduces welfare overall. If we turn to the land price, which we can think of as house prices, we also see that house price cycles are reduced, going from the 98 to 95%. The distribution is narrowed again, then moving to the more conservative one, it shifts to the left. So again, we find you can reduce the loan to value ratio, improves welfare, but you can also reduce it too much. We found, I think, under various conditions, an optimal policy of around LTV of 85%, but nonetheless, this is the general feeling we have, that if you tighten a small amount, you get an improvement in welfare, but moving too far, you get a reduction in welfare, essentially. So kind of what's going on here, we can say that the tighter LTV breaks what might be called doom loops that lead to crashes. So this table here, or these tables here, show the autocorrelations between various variables and the correlations between various variables. So variables such as land price and consumption, and correlations between consumption and credit, for example. The green categories here are those correlations and autocorrelations that have been reduced when you move from a policy of 95 to 90, or from 98, sorry, to 95. So what you're seeing is a reduction in these autocorrelations and correlations. So these correlations where you get an increase in land price building on itself, increase in credit, increase in consumption, and then get a crash in the land price, which feeds on itself, leads to falls in consumption, falls in credit, etc. So you lose these doom loops when you tighten the LTV policy. So this is essentially what we're seeing going on here in terms of the relationship between the variables in the model. So to summarize the DSG model, in the short run, we see that land price growth is moderated. This reduces household leverage and leads to a subsequent drop in the land price, or at least the subsequent drop in the land price is reduced, I should say. In the long run, land price cycles are curbed, we get more stable housing market, and welfare is improved with higher and more stable consumption. So those are sort of all the models we've put together to try to analyze this. We used a multifaceted approach, as I say, in order to analyze the effect of borrower-based measures on the housing market. Generally, we found that borrower-based measures improve the welfare of households without significant side effects. We found that house price cycles are reduced, household default and negative equity are reduced. Households do not appear to be permanently kept out of the housing market, though they might have to wait a bit to get into the market. However, some of these benefits only appear in the long run, so we need a long-term view. So it will curb the growth in house prices, so people's wealth won't grow as much in the short term, and households might have to wait before they get into the market. But nonetheless, in the long run, you do see an improvement in welfare and an improvement in the households and the economy more generally. So that would be the conclusions that we come to here. And hence the title, Thank Me Later. You know, sit through the momentary pain today, you'll find in the long run, everything will be, well, things will be better. So that's the paper today, or the presentation. If you have questions, I'd like to hear them, and my email's there if we don't get to questions here today.
Yeah, thanks very much, Graeme. That was like a great presentation, very, very insightful. So yeah, as Graeme said, we kind of can open it up now to questions. So if you have like a question, please either kind of raise your hand in Zoom, or you can put a star in the chat box. So while we kind of start collecting those, let me maybe take the privilege of kind of the chair to start with a question of my own, which is, so probably the most striking thing from your presentation, it's kind of more like a meta question, is actually you had this three-pronged approach, right? So you had like an econometric approach, kind of an agent-based model, and the DSG model to tackle that question of household indebtedness and kind of the different policies in Denmark. So was that more like, you know, an accident that, you know, different people, different colleagues in your organization kind of started doing different things, and then you kind of, you know, kind of lined up, or was it more like kind of, was there like a strategy behind it to, you know, fill different gaps that the different approaches had, that made you kind of choose these different kind of approaches to tackle that question?
Yeah, it was partly accident, partly design, I guess. I'd worked on this agent-based model previously. I previously released a working paper using the agent-based model. Then Eddie came with the DSG model. He had used that previously. And then just the empirical microanalysis seemed to be a reasonable way to then try to ground these two models in that, and we could get sort of access to fairly good household data. So we had them all in place, and then decided, well, this would be a good way to actually combine them and you know, to try and attack this question from different angles, given that we had all these, or had these different models and different ways of looking at it. We thought, well, that seemed to be a reasonable way to go about it.
Cool, thanks. So I'm seeing there's a question in the chat box. I'm just reading it out aloud in case people are kind of dialing in with their phone. So the question is from Remy, is how are the probabilities in the empirical microanalysis calculated? Is it the OLS estimation or any other method? So that's, yeah, on the first bit, I think.
Yes, I'm mainly on the agent-based model. I think these technical questions are best to Rasmus. I'm not sure if he's on the call. I don't know if he's able to talk.
What probabilities exactly? The left-hand side. Yeah. So the whole thing is just a big OLS, yeah, with lots of factors to try and suck out anything that we don't want in there. Yeah. I mean, I'm not sure exactly I understand the depth of the question. I think the probabilities are taken from the data.
So maybe, I'm not sure, and Remy come in, so maybe the question is, so what's the probability of buying your first home, right? Because you can only observe it when somebody buys it.
The output variable. Please, can you give a few more details about how are these probabilities calculated? Just a few details to have a clear picture of the estimation.
So the exact details escape me, but with the data, we have both people that sort of do buy and do not buy. What we don't see is the people who would like to have bought a house, but which were, for instance, blocked by their bank. So we take the characteristics of the households So for a given age of the household and a given municipality and a given time, we can sort of see who are able to buy. So what sort of age do they have, and where are they in the income bracket for their respective age and area. So for instance, if you're I think say 35 to 40, and you can sort of calculate for this group in this area, where are you in the income distribution, and have you bought a house or not. Yeah, but the equation, I mean, the way it's written there, it looks like it's aggregated up. I'm not sure that's the case. I would have to go back and look at the paper, or even better, the exact regressions that were run. But that's the gist of it. I mean, that you sort of look at the subset of households and the characteristics that they have, that were able to enter the housing market, and the characteristics of the ones who were not, and especially how and if it changed under different sort of regulation regimes.
Okay.
I don't know if that...
Yeah, that's clear. Thank you.
Okay, great. Then next question, I think, Adrian, you're raising your hand.
Yes. Hi. Thanks for the presentation. Can you hear me?
Sure. Yeah, I can hear you. Yes.
Yeah. So I have a question. I know this is not the focus of your work, but in order to be able to compare your model with the Bank of England model, I would like to know more about the rental. So you said there is some kind of large provider of rental accommodation, right? So my question is, does the supply for rental accommodation vary in time?
No, it doesn't. So in our model, so that's also a difference to the Bank of England model. So basically in our model, when houses are created, they're assigned to either be owner-occupier or rental accommodation. Okay. And then they stay that the whole way through. So this is, again, consistent with Denmark. Generally speaking, you don't see that houses or flats change between being rental accommodation or owner-occupied accommodation. So the house is essentially a rental accommodation, for example, and then the rental property owner just puts it on the market when they, when it becomes vacant, essentially.
Okay. Okay, so I take it then there's no competition for resources, right? So it's not like this institutional rental accommodation provider then buys houses from the purchase market.
No, that doesn't happen. No.
Okay, cool. Thanks. That's clear.
Yeah.
Okay, any other question by anyone? So you can either put it in the chat box or raise your hand, or I guess at this point just unmute yourself. Okay, so people are still mulling it over, so maybe to give people a bit more time to come up with maybe a few more questions. Let me just ask one question. So did you try to compare like the performance of the different models in some ways? I mean, it's it's probably not what you were setting out to do, right? But there's some work by Sylvain, I think, who tries to come up with like ways you can directly compare the performance of like different types of models, like agent-based models and DSG models. Have you tried to do that, or are you kind of considering doing that, or are the models just like too different to really get at that?
No, we haven't really considered that. I think we sort of, I don't think we even came to a question of doing that or not. We just sort of considered quite different ways of attacking the problem. So, and we're answering slightly different questions perhaps within the overall problem. So they were kind of fairly distinct, ways of attacking the problem. So we haven't really compared across models, no, other than to say, where they came to similar conclusions or where they came to contrasting conclusions. We'd mentioned that, but we haven't sort of said, therefore we'd trust the one over the other or anything like that. By and large, I don't think they had too many contrasting conclusions anyway, but yeah, we haven't really compared them in that way.
Okay, thanks. Anyone else? We have about 2 minutes, so I guess that's probably the last question. Okay, people are probably, at least in London, the weather isn't that good. Maybe people are all kind of getting tired and sleepy already. Let me then just like maybe finish with like a last question. So you briefly mentioned at the very end what you said. That the results aren't kind of too different from each other. But was there anything where kind of one model, said something that seemed to contradict what another of your approaches kind of produced, or was it literally like all kind of consistent with each other?
Nothing's really jumping out to me, nothing major anyway. I don't think we had too much that was, so different that we needed to sort of really figure out what was going on between the models. It was more within the models we sort of needed to figure out what was going on. So no, I mean, I think they kind of were saying the same things, that, generally borrower-based measures don't seem to be having too many negative effects or side effects anyway, but they do seem to be doing what they were meant to be doing in kind of all the models. So while they might sort of have slightly different ways of expressing this, I don't think there was so many clashes that we really had to stop and think about too much, no.
Okay, thanks. Okay, last chance if anybody has a further question. If not, then yes, then yeah, thanks very much, Graeme, for this really, really interesting presentation. Definitely to the participants, get in touch with him at this email address if you have any further questions. Also, if you know any further colleagues that you think haven't heard of this seminar series yet and might want to join us in the future, then please ask them to just send us an email at ABM4Policy@gmail.com so we can add them as well. And yeah, that's it for today. So thanks a lot. We'll see you again in 2 weeks, and we'll send out an invitation for that in due course. Okay, thanks all, and yeah, have a good day. Bye.
Thank you.